You guys read the weighted average cost of capital little paper? You did, right? Did do that. And crank through a little bit over the weekend. Did you do the problem? Little sample problem that I gave you. And then we got 2 more times on this. This is kind of a tough concept to get across. Okay, get down. Okay. Get comfortable with it. We're going to try valuing, what was it, Young and Target. Okay? And you can value any companies you want. Okay? Once you can do this, you can value anybody. Okay? Extremely valuable stuff. Extremely. So what I would like to do is go through the model. I'd like you guys to tell me what the model is. Okay? What am I trying to do? What's it for? This whack captain stuff. What's it for? What am I trying to accomplish? I'd like to know what. You got to know what you're doing before you start, right? What's my client goal? Okay, where do I want to be? If I'm out doing financial statements, I know I want a balance sheet, income statement, cash flow statement, I want all of that. What are we trying to do here? What do we want to know? Company's value. And basically what we'd like to know probably, if it's publicly traded, certainly is what? Value per share. If it's not publicly traded, it might be value as a whole, right? You might be buying the whole thing, right? But then you can still divide the number of shares they happen to have and you get the value per share. So the value per share obviously is the value of the company divided by the number of the shares of stock. But that's the value of the equity, right? Not the value of the assets. Who owns the assets? Who owns the assets of the company? Yeah, the stockholders. Really? They own all of them? They own a bunch of them, but not all of them. Who else owns them? Anybody have a house? Anybody have a car? They're still paying for it? Right? Do you? Anybody have? Yeah. You got a car. You guys don't know what kind of stuff, folks. You got a car? You own all of it? Or does the bank own part of it? Or whoever finances it for you? Both pay. Right? Own part of it. Right? And you're paying for it. Right, guys? You don't own it all. So in companies, how do we represent the portion that the shareholders own relative to the portion the debt holders own of the assets? I think it's a balance sheet. I really do. So let's not lose track of what we already know when we do this, okay, guys? You know what I really probably like to do too. Line narrower, we'll get more on the page. Good. All right, so yeah, we got assets equal liabilities with equity, right? The portion of the assets that are owned by the debt holders is represented by liabilities. The portion owned by the equity holders is represented by equity. Right? The market value per share is going to be what? The total value of the equity divided by the number of shares. Don't you think? Just common sense. Let it be common sense. So how does this model work? What are we doing? We want to estimate the value of the equity. That's it. Okay? And then per share. So how would we approach it? What are the formulas? I think I did, but then it disappeared. I did. Yeah, I just dumped it down on this. Thank you. Okay. You actually want to listen to this again? Yeah, maybe. Okay, yeah, not really, but maybe you will. Okay, so what do you think, guys? Let's do the formulas first. What were the formulas? You can look at them over here. It's all right. I don't care. You can look at the handout that I gave you. What are the formulas? What do I do? What's weighted average cost of capital? Weighted average cost of capital. What? Equals what? Tell me what the formula is. You guys did this, right? Crank through it. Crank through it.
Debt percent times cost of debt.
Okay, so the weight of the debt times the cost of the debt. We use K because C is consumption economics. Okay? So we use K for cost. That's what we use. Okay, weight of the debt times the cost of the debt. Those two multiply together. Plus what?
Plus equity percent times cost of equity.
You got it. That's exactly what it is. Okay? Now let's look at this. This is how much we think we need to earn on our assets to keep our debt holders happy and to keep our equity holders happy. In other words, to maintain the share value of the stock we have, right? To justify the stock value we have. So what we're saying is, what we need to earn on the assets is weighted average cost of capital. It's also called threshold, right? If I want to do a new investment in the company and I don't want to change the value of the company, I will make sure I earn WACC, weighted average cost of capital, okay? People really use this. The cost of the debt, of course, is what we pay to the debt holders, and it's what we pay to the debt holders net of tax. Oh, it's the cost of the debt. What is that? What do debt holders get? Interest. But then what do we do with the interest? Put it in our tax return, and we deduct it from our income, don't we? So let's say I'm in a 10%, I have a 10% interest rate, but I'm in a 30% tax bracket. How much of my interest does the government pick up? 30% of it, as long as you're profitable, right? Any dollar I put on my tax return is an expense. If I'm in a 30% tax bracket, what happens to my taxes? $1 less taxable income, what happens? I save 30 cents. So every dollar of interest that I put on my tax return, how much of it would the government pay? 30 cents. How much would I pay? 70 cents. That's why it's 1 minus the tax rate in the formula. Let this make sense, right? What if I'm in a 40% tax bracket? Well, now the government pays 40% and I pay 60%. It's true, right? Everybody got it? What if I'm losing money and I have a 0% tax bracket? I get to pay all my own interest. The government doesn't help. Got it? When you start going into bankruptcy, you lose the benefits of making money in a variety of ways. Okay? Yeah. All right. But that's it, you guys. Think about that. My percent of my debt times the cost of my debt, plus my weight of my equity, percent of my equity times the cost of my equity, must be the average I've got to earn on my assets to keep everybody happy. That's all this little formulas do. Get it intuitively. Huh. So that cost is a what? It's like an interest rate. It's a discount rate. I'm going to use that to discount what? What do the assets generate for me? You know this. What do the assets generate for you guys? Revenues. But I also incur costs against those revenues. Those revenues are going to be future what? The better these. Future cash flow. Right? Not at the same time you earn it necessarily. There's deferrals and accruals, right guys? But revenues are going to be future cash flows, or they're not revenues, by definition, right? Right in the definition, a revenue has to be realized or realizable to be a revenue, right? You have to get cash. Either have already gotten it, or you're going to get it in the future. Right guys, you know this. Okay? So revenues are future cash flows. Well, then what's the offset? You're going to incur what to get the revenues? Costs and expenses, and they're future cash flows too. They're just cash out, right guys? So it's the future net incomes, isn't it, guys? Current net incomes are future cash flows, right? Future net incomes are also future cash flows. Got the idea? So what are we going to do? We're going to estimate all the cash flows we're going to get. And then we're going to do what with that? Discount. At what? Where do you get your cash flows from? Only your liabilities, only your equity, or all your assets? No, all the assets. We don't separate them when we invest in them, right? How much was debt and how much was equity? We don't know how much came from debt holders' assets and how much came from equity holders' assets because the assets are all put together, aren't they? So if you could estimate all the cash flows that are being generated by the estimates, and then you discounted those by the cost that you should earn on those assets to keep both your debt holders happy and your equity holders happy, if you could do that, you could value the assets. You would not have valued the equity. You would have valued the assets. So all we're going to do is we are going to take our estimated cash flows, right, and divide them, discount divide the weighted average cost of capital. No kidding. Now wait a minute. How do you get the estimated cash flows? What they give you in the formulas for that, you guys? How do you get your estimated cash flows?
Income from operations before tax times 1 minus the tax rate plus depreciation.
Operating income before tax times 1 minus the tax rate.
Yeah.
And then add to that
Depreciation.
depreciation expense, not accumulated depreciation. Okay. Depreciation expense. You know what we're trying to get here? We're trying to get cash basis income sorted. A quick and dirty way to get cash basis income. Why do we use operating income before tax instead of net income before tax? Finance people do this. I don't really like it very well. I wouldn't use net income before tax either. You know what I'd use? I'd use all the revenues I expect to continue in the future, less all the expenses I expect to continue in the future, and any gains and losses I expect to have year after year after year. What I want is what my normal income before taxes is from running my business. Why do they want to leave out the non-operating stuff? Because they think it's not repeating. Well, I think that's discontinued operations and extraordinary items, and I certainly leave that out. What if there's reorganization costs? I'd leave that out too, unless what? They have reorganization costs every year, and I'm leaving it in. Because I expect it to happen every year if it's happening every year. If it's once every 40 years, okay, right? But if it's every other year, give me a break. That's normal operations, and they're just burying it down below the line. We already talked about that, huh? People like to show things in non-operating instead of in operating. One of the reasons is this formula was going to pick up operating. So I want to make operating look good, but the bad stuff down below. Well, don't buy into that. Look at the income statement and say, okay, which revenues are going to continue, which aren't, which are normal. Which expenses are going to continue, which aren't. Which gains are going to continue, which losses are going to continue. And everything that's going to continue, I want in. And I want it before tax. And then they take it times 1 minus the tax rate. Well, I got to ask you, isn't that estimated cash flows the first part there? The operating income minus, or times 1 minus the tax rate. Isn't that going to be after-tax income? Yes, if operating income is net income before tax, right? But it gets worse. My operating income really isn't operating income. It's really what I expect to have going into the future. That's income, okay, before tax. And my tax rate isn't necessarily the tax rate I used or I had this year. What if this year I had a big tax break of some kind, right? And my tax rate is only 15%, but in every other year my tax rate is 30%. What are you going to use? You're going to use the 15% that was this year or the 30% you expect it to be every year going into the future? Here's what you expect it to be. We're guessing the future here, right? So what you might do is you might take all 3 years' tax rates, it's right in the notes to the financial statements, the tax rates, they show you what their average tax rate was. Or you compute it yourself. How would you compute that tax rate? How about tax divided by net income before tax, right? That's all they do. They show it in the notes of the financial statements, the income tax and stuff. So once I have those tax rates for 3 different years, could I analyze why those 3 years might be different or might be the same? If they're the same, I could probably expect that into the future, right? If they're different, there was something going on in one of the years. Got the idea? So don't just use the most recent one. Let yourself think about this stuff. This is an art, not a science, okay? You're trying to figure out what's really going on with this business. And you just keep asking yourself questions. Oh, what's going to happen in the future? What's going to happen in the future? What's going to happen in the future? That's what I'm looking for, okay? So yeah, sure, I could pick up the net income after tax, and it might be the same number here, right? In the little example I gave you, right? In the case that we gave you, you know, it's the net income, right? After tax. But it won't necessarily be when you calculate it, okay? And then why do we add back depreciation? It's the biggest non-cash item. It is, isn't it? Depreciation and amortization is the biggest non-cash item. So you add it back to get an approximation of what your cash flows are. Make sense? That's it. What you've got is an approximation of your cash flows here in estimated cash flows. And then what we do is we tell ourselves, well, we think we're going to get those forever. Now we can get far more sophisticated models. We can put growth in. We can put growth for 5 years positive and then negative growth through a business cycle or something like that. You can do all sorts of things with this model. Of course, you have to figure out your crystal ball and guess the future. So at this point, we're just going to keep it simple. We're going to assume we're going to have those cash flows forever. next year, year after year after year after, okay? So what happens mathematically is instead of taking those estimated cash flows for each year and discounting it for the number of years, instead of taking these estimated cash flows and discounting it, the first one for 1 year, the second one for 2 years, the third one for 3 years, and so on, it's to infinity, right? So it breaks down to estimated cash flows just divided by the interest rate equals the present value. So your cash flows forever, right, through infinity, divided by the interest rate, if it's through infinity, will give you the present value now, okay? I can kind of give you this intuitively, right? We could prove it mathematically too, okay? It's true, okay? It approaches, right? As it approaches infinity, this will work. Let's think about if I had $100,000 that I invest in an account, and it earns 10% every year, right? I'm sorry, or if I'm generating $100,000 out of the account that earns 10%, how much must be in the account? So here I've got my cash flows, I've got my WAC, right? And I'm assuming those cash flows are forever. What must those assets be worth? Well, let's think about it. How much would you have to have invested to earn $100,000 every year forever if you were earning 10%? You have to be million, guys. Can you get it intuitively? $1 million invested at 10% interest, right? Add 3 zeros there. $1 million invested at 10% interest will give you what? 100,000 forever, right? 100,000 each year you take out forever. So by definition, if you're going to get 100,000 forever, and you should be earning 10%, those assets must be worth $1 million. Okay? So what we think we know is what the cash flows are, and we think we know the discount rate, right? The cash flows are based on how much money we're earning, right? Income here, okay, after tax, plus depreciation because it's the major non-cash item. So we think we know what the cash flows are going to be forever, right? By the way, what's your best estimate of next year's cash flows if you don't have any information other than what last year's was, this year's was? What's your best estimate of next year? Same, right? If you have additional information, it might be growing, it might be shrinking, right? Or there might be something changing, management changed, major stockholders changed, there's a competitive change. You have to bring all that in, right? When you're thinking about this stuff, we won't. We'll just keep the model simple, right? We're going to assume everything stays the same. So if everything stays the same, what would be your estimate of future cash flows? Well, probably the same as now, huh? Right? If I told you how much money I made this year at Bellarmine, you could guess really close to how much money I'm going to make next year. Because we always get a minimal raise every year, private years. So you know what? A couple of years ago, I got a big raise. Just boom, because we adjust to the comparison schools. And I don't know what happened. A bunch of people maybe retired that had low incomes, and young people came in that had higher incomes. I don't know, but it's usually the case, right? Salary inversion in universities. The old people make less than the big people. Weird. That's the way it is, right? It always has been, I guess, at least in my lifetime, right? So it's just normal, okay? So I got a big raise because I'm being compared this to the big relative to what I usually get, right? Okay. All right. So guessing my future cash flow would be easy, wouldn't it? If you had the history. It's better than nothing, though, even for a company. So that's what we're doing. So I've got my estimated cash flows, and then the WAC is what? My estimate of how much I need to earn to keep everybody happy. Based on what I'm paying the debt holders in interest, right? And based on what the equity holders should expect to earn. Aha. So what I'm going to do is I'm going to say, okay, I know the cash flows, I know the cost of the capital, and I know it's forever, right? Or think it's forever, assume it's forever, and I've got the value of the assets. That's it. Once you have the value of the assets, by the way, what would you suppose you do to get the value of the equity? If you knew the value of the assets and you want to know the value of the equity, what would you do? Subtract the liabilities. We're not kidding. That's what the model does. So that's pretty easy. And then how would you get the per share value? Now you know the value of the equity. Divided by the outstanding shares, that's it. And oh, by the way, why is it outstanding shares? Do treasury shareholders earn anything? Nope. They don't, there's no cash flow for them. That's us. How about unissued shares? Same thing, we're holding those. It's the outstanding shares, of course, right? Yeah. So this stuff looks really complex, and then it's just really simple when you get your head around it. It's just really a simple concept, okay? Which is real powerful. It works pretty good for valuing companies too, by the way. Not perfect, but better than other things we have. So that's probably the way to put that. Just better than other stuff that we might have. Okay, good. So let's go back to this model over here. What you need to do then is get your estimated cash flows and get your WACC. And if you do, that is going to allow you to do what? I'll take my estimated cash flows divided by weighted average cost of capital, and what is that going to give me? It's going to give me an estimate of the market value of what? The assets. And then if you subtract from that your estimated market value of the liabilities, what do you have? That equals your estimated market value of the equity. And notice I'm saying market value every time. I don't care what the historical cost is if I'm buying the stock. I want to know what its market value is. Make sense? Okay. So what I want is the market value of the assets, the market value of the liabilities, and the market value of the equity. Everybody good with that? Makes sense, doesn't it? Okay. So, oh, by the way, one other thing. Like we said already, once I have that estimated market value of the equity, what could I do to get it per share? That's the total equity. Divide by the outstanding shares. Number of outstanding shares. You guys have convinced me you actually read this too. That's pretty cool. I like it. Okay. It's true, isn't it? That's the deal. That's what we're working with. Well, let's go back over here then and think about how to get WACC. We know how to get the estimated cash flows, right? We're going to take the revenues that we think are going to continue on the income statement, expenses that we think are going to continue, the gains and losses to get the amount of income before tax we think is normal, right? And then we're going to take that times 1 minus the tax rate, because the government's going to take part of our money, right? Okay, that's why we get to keep 1 minus the tax rate. Everybody's good with that? Everything's that way, right? Every decision you make is net of taxes. I hate it when in intermediate books they say ignore taxes. The CPA exam will do it too, ignore taxes. How many of you get to ignore taxes in your lifetime? Yeah. You don't have to pay taxes? Nope. Go to jail. Okay, at some point. All right? You do that, don't make any money, you don't have to worry about it. Yeah. You know, so yeah, you gotta pay taxes, don't we? Okay, so yeah. Anyway, it makes sense that we only get to keep the after-tax portion. It also makes sense that our interest only costs us the after-tax portion, right? Let it make sense to you. Okay, so fine. Anyway, let's figure out how to get these different things. I want to get KE, right? I want to get the weight of the debt, too. I want to get KE, and I want to get the weight of the equity. K is what? Cost. Okay, so let's do the weights first. How would you get the weights? By the way, the assets are 100% of themselves. I don't care if it's a historical cost or market value. Total assets is 100% of the liability plus the equity. There's no kidding. That's pretty cool. Not really. Simplistic, but it's true. So let's do it. How are you going to get those percentages? Well, that's going to be KD. I was going to do the weights, but that's okay. We'll do KD. What do we pay? What do the debt holders get? The interest, right? They're going to get interest out of it. But we get to write that off on our tax return, don't we? By the way, do you write dividends off on your tax return? No. There's no tax impact on dividends, is there? I guess. Okay. Times 1 minus the tax rate. By the way, do you think this tax rate here is going to be the same as the tax rate that we use over here in the estimated cash flows? Of course, it's the same company, right? The same tax rate. Sure. So you only have to calculate it once. So if I take 1 times, or I'm sorry, the interest rate times 1 minus the tax rate. What am I getting? My after-tax cost of interest. Let's do that again. If I had a 10% interest rate and I'm in a 35% tax bracket, how much of my interest does the government pay? Every dollar I pay in interest, I put on my tax return, it reduces my taxable income, and I say how much? 35 cents. So what does it cost me? $1 less 35 cents, so 65 cents. What percent is that going to be? If it's 10%, you say 3.5. 6.5. 6.5%. Is this intuitive? It's obvious, right? You got to know what the interest rate is, right? Okay, and you've got to know what the tax rate is, right? Pre-tax interest rate, and you got to know what the tax rate is. You can easily calculate the after-tax rate. So this is going to be the after-tax. KD is the after-tax cost of the debt. Okay? She wanted to cost first, so we did. It doesn't matter. They all go together. How would you do the weights? It's equity over assets. I want these two percentages to add up to 100%. So you're not doing debt to equity like that, right? I'm doing what percent of assets is liabilities and what percent of assets is equity, okay? So those two percentages will add up to 100%. And that's, you got to get these insights one piece at a time. Does each one of these little things seem pretty simple to you? Yeah, and does the whole model seem like it just explodes and you can't get your head around it? For most people, yes. Right? So just make them simple. Each piece is simple and just tag them together. Okay, connect it all together. And then it's not so bad. Okay? Get so this is intuitive. This is a great way to think about business. Okay? Great way to think about investment. It's a great way to think about running a business. Okay, what are we doing? Trying to maximize those future cash flows, aren't we? We really are, which is going to maximize shareholders' wealth. We also don't want to control risk. Okay, so you've got to worry about that. Okay, so how would you do it? What do you want to use for your, I think what we need is an estimate of the total value of the assets here. Market value, right? These are going to be market values. And then I think we need an estimate of the liabilities to get that, and I think we need an estimate of the equity to get that. What I'm suggesting is I don't know what the market value of the assets is. Do you guys? I don't know. I don't know what the market value of the assets is. I don't know what the market value of the liabilities is. Huh. So what do I need to do? Get estimates up. So I don't think going directly to the assets would make sense. How would you get an estimate of the market value of all the assets? Like get an appraisal on every single asset you own, all your land, all your building, all your equipment, all your inventory. Is that what you do? The only time you really know what anything's worth is when you sell it, right guys? Getting an estimate of market value of the assets is really a pain. How about an estimate of market value of the stock? Can I get an estimate of the market value of the stock for General Motors today? Yeah, it's publicly traded. You know how many outstanding shares there are. You know how much each share is selling for, and we could take the outstanding shares times the amount that it's selling for, and that would give us something called market capitalization. Go to Yahoo Finance, MS Finance, you can find market cap for any publicly traded company. A half hour, but you got to pay more if you value line or somebody if you want to pass it. Right? But we're not trading anything with half an hour. It's pretty good. So we can find out what the value was on any particular day, right? Of the whole company. It's the outstanding shares times the market value per share. They even calculate it for you, right? But you can do it yourself, of course. So a really good estimate of the market, we think, a really good estimate of the market value of equity is what, guys? It says the number of outstanding shares times what? Yeah, market value per share. That's it. I think that is going to give you a pretty good estimate of the equity. Don't you? Liabilities? We use as a proxy for the market value. We use the book value. Now, this seems really strange. We don't really want the book value, we want the market value. But we use as a proxy for the market value of the book value. You don't have to do that. But we without making a payment or without borrowing more, does debt change in value? Yes, of course it does. You guys know about bonds, right? What happens to bonds with interest rates today? Everybody likes your bond now. It's worth more. Interest rates go down, right? Your bond is a higher interest rate, right? It's more valuable, huh? I guess. So debt go up if you're holding debt. Right? Exactly. Wow. What if interest rates go the other direction? The opposite is true. So as interest rates change, bonds change in value. Everybody good? It's true. So what we could do is we could take our debt, we could take the discounted present value of all the future cash flows on the debt, all the payments we're going to make, and all the interest, and you discount it at the new interest rate instead of the old interest rate that's on the debt, right? Because interest rates change. The bond market does that anyway. If you have a whole bunch of bonds outstanding, if you value the bonds exactly the same way we just value the stock by using the market value of your bonds, you know, they're selling at 99, right, percent of the face. Can you take the face times 99% to get it? Sure you could, right? So companies can do that too. We're not going to bother with that. It's not going to make a big difference anyway, probably. So when we use book value, we're using it as a proxy for market value. So this is going to be pretty easy. I can pick up the outstanding shares on Yahoo Finance, right? MS Finance, either one. I can pick up the market value per share, same place. I can multiply the two together, or I can just pick up market capitalization. I got the value of the equity. And I can go to the balance sheet and pick up the book value of the liabilities, and I got the liabilities. Now, how would you get total market value of the assets? How about adding together the equity and the liabilities? That's all it does. That's all the formula does. Okay, big deal. And so I've got assets. So let's say I did this. You know, you had outstanding shares, little tiny company, or 1,000 shares. Market value per share is $100. What would we have as our total equity? 1,000 times 100 is 100,000, right? And then let's say they had debt of 200,000 on their books. What would you do? You'd add together the 100,000 you have for equity and the 200,000 you have for debt, and you'd have what? 300,000. How would you get the weights? 300,000 of total assets is what? 100% of the total assets, right? That's where we get the 100. 300 divided by 300. What would you say for your debt now? 200,000 out of 300,000. Be 2/3, right? So we'd say 67%, 66 and 2/3% here. That's where the weights come from, no kidding, right? But it's based on market values, not book values. Don't pick up the book value of the equity. Who cares what the historical value of the equity is? I care what it's worth now. Okay, that's all. Okay, and what would you do for your equity? 100,000 divided by the 300,000 is 33 1/3. And of course, make sure, you guys, that these two add up to 100%. They have to. The liabilities plus the equity have to add up to 100%. You wouldn't believe how many students I have. I'm not that up. You know when, right? You know what a balance sheet looks like. Okay, so great. So in my little example, I'd have 66 and 2/3% here and 33 1/3% here, and I'm not going to wait. Okay? As the example we gave, if we use 10% here and we're in a 35% tax bracket, I'd have 1 minus 0.35, wouldn't I? And what do I have? 0.65 here then, right? So I'd have 0.65, right? 0.065, 6.5%. 6.5%. I'd have 66 and 2/3%. Okay? And I'm just going to multiply the two of them together. Nothing to it. Okay? Do the same thing over here. I'd have 33 1/3. Fine. So the only thing I have left to do then, I think, is compute KE. What do you want to use for KE, gang? It's the only other piece. Let's start doing some real ones, man. What do you do for KE? Cost of equity. How did that paper Dan, David, and I wrote suggest? This is what the equity holder should expect to earn. This is what the equity holder should expect to earn on their investment in the stock.
Risk-free return plus beta.
What's the model called? First, you're right. Risk-free return plus, risk-free return plus beta times, right? Okay. So yeah, this is going to be capped in. The capital asset pricing model. How do you price capital assets? That's it. Okay. Capital being equity in this case. Okay. Capital asset pricing model. And so what is capped in? You said risk-free?
Yeah. Plus market risk premium.
Market risk premium, that's another way we put it. Yeah. Okay, so this could be risk. Oh, here, let me write it this way if you want to do that. We'll say we've got capped in is risk-free. It's a risk-free rate, okay? What you'd earn if you incurred no risk. Risk-free. Plus risk premium. That's true. Risk premium for the stock. We talked about this last time. What does the market expect to earn? What's the market return? 12, 13% over time. It has been. Okay? Right? Over the last 30, 40 years. So what do you think? You see the market exceeded 17,000 for the first time ever? Remember inflation, right? So there's inflation. But still, there's pretty good growth too, huh? Okay, pretty nice. What was the market at? How many years has Obama been president? Whatever it is. What was it after the day he took president? Right now.
6,000, 7,000.
Yeah, it'd be about 7,000. Yeah. Well, what had it been shortly before that? 14. Yeah. Yeah. So the real growth from 14 to 17 is not all that remarkable, right? Took a massive drop. But then 17 was probably, or 14 was probably way overpriced, and 7 was probably way underpriced, most likely. It didn't make any sense. Kind of irrational. So is it really worth 17 now? Nobody does. That's the gamble, right? That's the gamble. Okay. Where's your bets? So, but that's not a formula we can really work with, is it? So what would we do? Let's recap in a little more detail. What would it be, guys? What's the risk-free rate?
30-year treasury bond rate.
Yeah, we're going to use a 30-year T-bond rate. That's what I like to use. Okay, that's what I see. Okay, I think you're going to invest forever. You're not really. You're going to invest for whatever period you invest, but you want to, when you sell your stock or sell for, or if you buy stock, you're going to have to pay for what? All the cash flows forever. Just get it back to now. That's what you're buying. So I think using the longest rate we've got. So why do we use 30-year? There's no longer one. That's it. They were talking about getting rid of it too. Everybody was panicked. So what are we going to use the value anything? We don't know what the 30-year rate is. So, by the way, the 30-year rate is higher than a 5-year rate right now. Why?
Maturity risk.
Yeah, what's the maturity risk? What do we mean? Over time, what could happen? Anything, but the biggest thing is going to be what? Inflation. Yeah, inflation may fire up again. So if I'm going to wait longer, maybe the riskiness isn't more, although there is some with maturity risk, right? It's going to take longer to get your money so that more unknowns, right? But also, what's the deal? For the government, there are a lot of unknowns. Risk-free, right? What is unknown with the government? How much inflation is there? So what is that risk-free rate composed of? The two things theoretically? We talked about that last time. Risk-free is expected inflation and a true or a real return, or a nominal return, whatever you want to call it. So that same stuff we've been talking about, guys. That's what the risk-free is. So yeah, it's going to be risk-free, which really is composed of those two things, and we'll use the 30-year Treasury bond rate. And you can just look it up, okay? And that's probably as good as any other estimate. What is that right now, by the way? Anybody take a look at it?
3%.
yeah, it's pretty low, right? What is that? 2 or 3% for real return, and the rest is expected inflation. How much expected inflation do we have? Actually, it's a little higher. It's between 3 and 4. Yeah. The real short-term one's less than that. That's because they have expected inflation in the short term. Okay? The market doesn't. So yeah. And then what are we going to add to this? We're going to add a risk premium. Well, the market's risk premium is what? Maybe 12, 13%, whatever you think it is. Take out your crystal ball and guess. I'm not kidding. Okay? So you guess. Okay? So the risk premium is the return on the market minus the risk-free. Make sense? The market return is going to be risk-free plus their risk-free. Okay? So if you think about it, the return on the market, let's say it's going to be 12% forever, right? We're guessing. Okay? And let's say we think the risk-free is 5%. Okay? Let's use 5. What must be the risk premium of the market? 7%. What did the three of us suggest in that paper? Was a risk premium? No, 5 to 7. I think maybe even 8, right? 5 to 7. Okay? So my co-authors like 5 to 6. I like 7 to 8. So we settled on 5 to 7. There's 2 of them. 7 to 5 to 7. Okay? But somewhere in there. So what would you expect to earn on the stock market? Whatever the risk-free rate is, plus what you think the ongoing risk premium would be. Okay? Now I'll give this to you 2 different ways. Sometimes I'll tell you the return on the market. What would you need to do to get the risk premium if you do the return on the market? Subtract risk-free from it. What if I give you the risk premium? Say, assume a risk premium of 7%. What would you do? Add the risk-free to it to get the return on the market. You could go either way, right? But if I tell you 13%, do you think I've given you a risk premium or a return on the market? Do you really think the risk premium for the market as a whole is 13%, and then you're going to add 4 or 5% to that, or 3, 4, or 5% to that for the risk free? No, it'd be ridiculous. Okay, the market's not going to earn like that forever. Okay. What if I tell you though that it's 7%? Are you going to think that the market's only going to earn 7, and then you're going to take the risk free away from that, and the market's going to be happy with that? Why would suddenly the market be happy with 2 or 3% return? What does the market want for taking the risk across the market, across the S&P 500? What do they want? Probably 5 to 8% to take the risk. That's what you get. If you invest in the stock market, you get that much more than if you had not taken risk on an ongoing basis. But here's the problem: you don't know what inflation is going to be. Right? So do you necessarily get your expected return? Might you get something less than that or something more than that? Of course, you probably will. That one year the market went down, just in a few months it went down by 50%. That was an absolutely horrible year in terms of return. Huge negative, right? But in other years it bumps up 20, 25%, right? Okay, it happens. So we're talking about over time, what we expect to happen. Okay. That's the deal. So then you said this, you said something else. It was, what do we do to get our risk premium for the market? Or I'm sorry, for a particular stock. For the market, it's going to be just this risk premium over here. So you're going to take your risk premium, which is return on the market less risk-free. So you're going to take your risk premium times what? Anybody? Beta. All right, so we got to get this idea of beta down. So beta times risk-free. Okay. Beta times return on the market minus risk-free. What's beta? Individual stocks riskiness is compared to what? The market level. So with betas, what do we do with the market returns? What are the market returns? Anybody know? Pretty good. You invest in the market. Why do you invest? I put $100 into the market. What do I hope is going to happen? Plan on happening. Expect to happen. My expectation. That $100 investment is going to be earnings that are in excess of their costs, their expenses, right guys? They're gonna generate profits, they're gonna generate cash flows, and that's gonna make me wealthier. The stock's gonna go up in value, that's how they make me wealthier. Okay, so one of the ways is appreciation of the stock. Increases and decreases in the value of the stock, right? That's one. What else? And those are maybe cash flows, by the way, right? Sell the stock to get your cash flow. There are models that do that too. Right? That look at appreciation, right? Okay, what else? Something else you get on stock. Dividends. They get paid dividends. They don't have to retain earnings. So it's the increase in retained earnings, right? And the dividends that I'm looking at. Change in retained earnings and the dividends added together. Okay? So yeah. So what we talk about, that's the returns. And then we want to know what's the variability of our returns compared to the market returns. So what we do is we standardize the market at 1.0. So maybe what's happening is you've got the market doing stuff like this. It's going up and down and up and down, okay, over time, okay? Goes down and never go down enough, maybe, okay, but up and down and up and down. So over time, right, we've got dollars here, we got time here. Over time, the market tends up, right, includes inflation, of course, okay, and it includes real growth. So the market is going up, and what we do is we standardize this to 1.0, so we convert it into a straight line, that's all we do. And then what we do is a correlation of our returns on our stock to the markets. Now, our stock might be doing this over time. Are we more or less risky than the market if this is us? Let's say this is company A, and this is the market. What do you think? Well, let's see. If I have to sell my stock and we're at one of these low points, I'm dead meat, right? That's risk. It might be nice if it turns out here, but one of the other side of risk is return, right? So you might get a higher return for assuming more risk, maybe, right? But it could have turned out good, it could have turned out bad. It's intuitive, isn't it? Okay? So what would we say? If we did a covariation of these returns, what would happen? Covariation of these returns, what would happen? This one, company A, is going to be higher than 1.0, that's all. So we might be looking at a 3.0 there, as big as that thing is. What would we say if the covariation to the market is 3 times as much variation? It's real risky. We think that's a risky stuff. What happens if it goes like this? What happens if it's down inside here somewhere? What do we have? It's less risky. And maybe you have 0.5 or something. Are there companies that covariation? Are there companies that are 0.5? Yeah. Are they really half as risky as the market? I don't know. Their returns vary half as much, right? We're talking about variability of returns, really. Yes.
I was going to ask what covariation.
It's a measure of how much variability you have relative to the market. Okay? So if you are varying more than the market, if you are varying exactly the same amount as the market, you track directly with the market, you look at the variances between your returns and the market returns. The market is everybody all put together in an average, right? So if you vary more than the market, you will have a beta of more than 1. Just the covariation is, I'm varying more than them, higher than the 1.0. They're standardized at 1. If I vary less than them, I have a covariation less than 1, a beta less than them. So it's just my movement relative to the market. Does that make sense? Okay. And we can compute it, but we do it for us too. Right? By the way, can you look up betas? Oh yeah, you got the Yahoo Finance, you can look at betas. Here's the problem. You go to Yahoo Finance, you go to MS Finance, you go to Value Line, you'll get different betas a lot of times. Why? Why would that happen to you? Because they use what? Different time periods change. Someone uses a longer range of time, and someone uses a shorter range of time. So by like there'd be different levels of variability in a given stock and on the market for that matter for different lengths of time. Yeah. So would that affect it? Yeah. The other thing is some might be measuring daily, some weekly, some monthly. Would that affect the variability? Yeah. Okay. So the numbers wouldn't necessarily be the same. So that could really difference. So like I said, this is art, not science. If you're really valuing a company in real life, you might use a number of them, right? And then you might adjust the beta to something you think it should be. By the way, what if it's not a publicly held company? Can you still use this model? Sure, but you have to estimate what you think the beta should be. And what we'll do is we take the beta for a similar company out in the market, a big company, and we bump it up because you're a small company. Subjectively estimated at a higher level. It's still valuable to do this. Mostly all you're getting out of this whole process is better information to make a decision about the company. You don't really know what the value is. What if I could really value a company? What would I do? What if I could value it and nobody else on earth could? And I could value any company. I know how, you don't. What would I do? Would I share it with you or would I place bets? Would I place bets and capture all the wealth in the world? Nobody can really do this, but what if you go through the process and you look at what you expect those captures to be, and you estimate what you think the riskiness of the stock is, and you try to come up with an intelligent estimate based on a whole bunch of estimates, right? Intelligent estimate based on a whole bunch of estimates. This is crazy. And a whole bunch of assumptions. What if you come up with what you think the stock might be worth? Is that valuable? Sure. Because you can compare it to the market, and if you're way off, what does the market know that you don't know? Or maybe what do you know that the market doesn't know, right? Is the market crazy here? And people make a lot of money. There's some guys that bet on the collapse of the banking, right? Yes. Subprime loan thing. They said, this is crazy. Subprime loans are worthless. These banks are basing their values on them. It's crazy. They bet against it. Made millions. Right? Some people thought that was not major reality. They bet that the system was going to collapse. Right? Okay, so if you think a stock is overvalued, place a bet. If you think it's undervalued, place a bet. But would it be useful really to ask, well, why is it valued the way it is? If you're running the company, you're inside the company. Would it be nice to try to figure out why does the market think this when we think something else? Right? What's happening? What could be driving that? Okay? There are so many assumptions, and we'll get to that as we go through. Okay? So, what do you do now? I've got the risk-free plus the company's beta times the risk premium. Just add them together, and you have cap M, right? Which is what? The cost of equity, okay? Cap M is the cost of equity, right, guys? That's it. So you can plug that in now. And all of it looks like, man, this is just magic, huh? So let's try a little example. Let's say that we think the company's beta is 2.0. They're real risky, okay? Let's say we think the risk premium is 6%. And let's say the 30-year Treasury bond rate is 5%. Tell me what the market return is. Risk-free is 5%, 30-year Treasury bond. Beta of the company's 2. The risk premium is 6. What must be the return on the market? Back into that for me. What did I just say risk-free was? I said risk-free is how much? 5%? So what do you think the return on the market must be if the risk premium is 6? This risk premium is 6%, you guys. The market wants 6% in addition to risk-free. Okay? You believe that. And then you kind of pull out of the air, right? That's your belief. You think it's 5, 6, 7, 8. What do you think it is? Okay. What must you think the market's going to earn forever then? Must be 11. You got it. Because we've got this, it has to be 11% for the return on the market, minus 6% for the risk-free, right? Leaves me what for the market return? Or for, I'll get it out. That leaves me the 5%, right? No, I said risk-free was 5%. Come on, keep 5%. I got 11% return on the market, 5% risk-free would give me the 6% risk premium, right? 6% is the difference. Okay? So again, if I know what I think the return on the market's going to be forever, what if I thought it was going to be 12% forever? Do you think the market's going to earn 12% forever? Which is kind of my belief structure. I think it's going to be around 12. Okay? Because it has been for my lifetime, my investing lifetime. So if I think the market's going to return 12, and right now risk-free is 5, what do I think the risk premium must be? 7. So see, you can back into either one. Be comfortable with that. I can give it to you both ways. Okay, anyway, what would this company expect to get? Investors in this company, do they still want to earn the risk-free? Well, everybody wants to earn at least the risk-free, right? And then what do you want? You want the market risk premium times what? Your beta. How much more return does this company expect to get because of the riskiness of the company? Shareholders expect what? Double the risk premium. It's a beta of 2, that's all. It's a beta of 3, they want triple. It's a beta of 0.5, they only want half as much. Okay? So what would it be? 12% here, plus 5%. How much is KE, capital asset price, not CAPM, KE? How much is that for this company? 17%. Why is that more than the market's 11? Because there's another 6% for risk premium, right? Into 17. What if it was a beta of 3? What would you have? You'd have 3 times 6 is 18 plus 5 is suddenly 23. See how CAPM can get high? What if it's a beta of 0.5? They're only half as risky. A real stable industry, right? You're going to see these young brands, right? You know, everybody's buying poisonous foods, right? Okay. Beta's real low. Okay, they're big. Sales are pretty predictable. You know, everything's pretty predictable. Okay. What would you expect to see? What if you had a 0.5 beta? Make that 0.5. What happens with the little model? Now the risk premium for that company is only 3% added to the 5. They'd be 8 for CAPM. See how CAPM would vary based on your risk, right? Okay. Everybody happy? This is easy, isn't it? So what do we do after we have all this stuff? That's what makes this hard. Is geez, it just keeps going, huh? What do we do after we have this? Let's say we plug. What was the number I came up with? 17%. Okay, it's pretty high. I've got KE 17% over here. What would I do? 1/3 times 17%. 2/3 times what? 0.65, right? Or 6.5%. 0.065. Okay, 6.5%. So I've got 2/3 at 6.5. What's that about? 2.1 or something?
4.3.
And then, or 4. I'm sorry, 4.3. And then over here, 1/3 of 17 is what? 6.7. 5.7. Add those two together. By the way, those two numbers mean nothing, right? It's just a weight times a rate. Those by themselves don't mean anything. But you add the two together, what do we get for the company? Right around 10?
Yeah.
Oh, wow. That's much. So 10.0%. Even numbers are just as likely as uneven, right? Okay, just a lot more uneven. 10%. What does that mean? Tell me what it means. How much do the debt holders expect to get? 10% interest. How much of that's the government going to pay? 40%. What does it cost us after tax? 6%. Our debt costs us 6%. So 1/3 of our capital, 1/3 of our assets, right, cost us 6%. What does the other 2/3 cost us? 17%. Everybody got the idea? I've got to earn 17% for the debt holders, for the equity holders, and I've got to earn 6% for the debt holders. The government's going to pick up 4%. Right? Or 6.5. The government's going to pick up 3.5. So what does this 10% mean? If I earn 10% on my assets, I will be able to give 17 to the shareholders. I'll be able to give 10 to the debt holders, and then I'll save 3.5 on my tax bill, so I effectively get another 6. And they'll all be happy, and I'll maintain my stock value. So 10%. What would I do with that 10% now? What do I do, guys? Plug it in. So what's the other piece I need to have? How much are you getting out of your cash flow? So I take my normal operating income, right? Let's say that's 150,000. Okay, I'm getting 150,000 a year for all thousands. Okay, so boy, you're generating a lot of 300,000 assets. That's pretty cool. Okay, 150,000, good company. My tax rate was what? 35%. How much do I get to keep of the 150,000? That's all we're doing. What's 0.65 times 150,000? Right? After taxes, what you get to keep. This would be my normal revenues less my normal expenses. Right? Just for continuing to get the loss. On a monthly basis. What's that going to be? What's 150 times
97,500.
Okay. Boy, is this a good company or what? Okay. Anyway, and then what would I have to add to that to figure out what I think my cash flows are? By the way, could you adjust that for changes in current assets and current liabilities? Sure, you can if you want, but then you think those changes are going to happen forever. It's a little bit much, isn't it? Right? Okay, so you usually leave them out. Add what? Depreciation. Let's say my depreciation is only $40,000 a year. What's the total cash flow I think I have? This year and every year into the future if I don't have growth. Then we'll add growth to it next time we're in here. 137.5. Is that right? You're doing really good. This is 137.5. What is this company worth? What are the total assets worth, you guess? What's my estimate? 137.5 divided by 10% is how much? 1,375,000. Now what would you do with that? That's my estimate market value of the assets. 1,375,000. What would you subtract from it to get my estimate of the equity? My estimate of the value of the debt. I already had that, didn't I? What I used as a proxy. Book value, that was only 200,000, huh? So, given these great cash flows, what's my estimated market value of my equity? 1,375,000 less 200. How much is that? 1,175,000. Yeah. What would you want to do with that? That's my total estimate of the market value of the equity. What would you want to do with it? Yeah, divide by the outstanding shares. How many did we say we had? 1,000 shares. Boy, are these valuable shares. Huh? Got it? Boy, something's not very good in my example. The stock was selling for $100. What should it be selling for? $1,000, huh? 1,100. 1,175. So what must the market think of you if it's only selling for 100 and you think it's worth 1,000?
You're a liar.
They think you're lying to them. They think that your income isn't really that much, right? Your cash flows aren't really that much. Or they think you are a lot riskier than they imply. Okay? One of the examples go the other direction. But it will when I can. Okay. If you don't work that little example, try it. And also, did I suggest 2 companies for next time? Do both. Or do one of them. Do a company you want. Pick another one. It's nice this summer. We have 2 days for this. So. How do you find the market return on the whack tap problem there? You have to come up with what you think it is. But you do know what the risk-free rate is, right?
Correct.
So what was the risk-free there?
4.7%.
So what do you think the market could earn forever?
Whatever I want.
12,
Did you say 12, like you said? Say 12.
You use 12. Or you could add 7% to 4.3, was it? Yeah, that'd be 11.3. You could add 8% times 12.3. Whatever you want. You want to do it. Have fun.